So very good morning to you all. Today, my agenda, I hope I get successful, is to cover two topics today, and they are operating leverage and the financial leverage. I hope we haven't done it before. As well as, have we done them? No, good news. I'm forgetful. So we will do operating leverage and financial leverage. And there is a task based on each of these two topics, right? Operating leverage is basically referring to what percentage of fixed cost we have in the total cost. If you look at the company's income statement, you will see that on the one side, we have the expenses. And in the expenses, we have the fixed cost. And when you add up all the costs, so we calculate the total cost. So sometimes you're interested to know what percentage of fixed cost is there in the total cost of the company. Okay, so it's very important for you to be careful of. The fixed cost, they vary from the company to company. In some companies, the fixed cost is huge. If you are an oil and gas company or a airline, I can imagine, or engineering company, I can imagine that the fixed cost would be enormous because you need building, you need not only one building, you need a chain of building, you need a fleet of transportation, haulage. If you're an oil, exploring company, you need the oil rigs and so on and so forth. If you are an airline company, you know that you have a huge fleet of aircrafts. But on the contrary, if you are a IT company or a service-oriented company, I think then your fixed cost is comparatively less. Now you all live in this housing apartment, this student housing, yeah, Kuas, many of you. Now you see what that company's fixed costs are huge, isn't it? Look, it's all infrastructure, all building-based, construction-based, everything is so tangible. So the fixed cost depends on the company to company or industry to industry. The firms with the higher infrastructure needs and their rigid cost structure are often riskier than the other companies. If your cost structure is very rigid, you can't change it. What would you change? I mean, if you're an oil company and you have an oil rig in North Sea and you are trying to save some, let's say, there is some equipment about the safety and security. Would you dare to touch it to take it away? That could be catastrophic. And this is exactly what happened in Gulf of Mexico crisis. If you remember, many years ago, not many years ago, but yes, still many years ago, there was a Gulf of Mexico crisis that the security equipment needed some change. And the company was having, I think that was the crisis period which started in 2007, yeah. The company couldn't afford, they were trying to postpone the repair or replacement of some of the security equipment. And see what happened eventually? It was a massive catastrophe. So there are some industries, there are some businesses where the cost structure is really rigid and very linear. So if you dare to make a change, it can backfire with very huge ferocity, and it can be really, it's not very pleasant experience to go through. Similarly, the smaller companies, they find it very hard to bring changes in the cost structure. So basically the idea is that those companies, big, small, new, old, wherever the cost structure is rigid, number one, and number two, the fixed cost make a very big proportion of the total cost. In those companies, it's quite likely that the beta, the coefficient of slope, the measure of market risk / systematic risk / non-diversifiable risk, so on and so forth, would be very high. So that is what is some theory. The young firms are also likely to have the higher beta because the young firms are primarily in very offbeat professions, like they are more into IT, biotech, and these kind of very risky professions. All right, and how we do it? Very simple, very simple. How we do it? We measure operating leverage, as you can see. I hope I'm sharing it. Yeah.
Yeah, we can see it.
Okay, very good. That's good. I totally forgot. So the EBIT, sorry, the operating leverage is measured as the percentage change in the EBIT. You know what is EBIT? The full form is earnings before interest and tax. And if you want to know the more conceptual name, it is called net operating profit. Net operating profit. Remember that, well, I hope you remember by now that you have total revenue. From the total revenue, you subtract total operating cost. Operating cost includes the cost of production, which you have in the factory. Then in the warehouse where you do the packing, then you have some transportation cost. So these are the costs which are incurred that the product or a service is produced from the very scratch, the basic, and then till it's delivered to the customer. So operating cost is not just including the production cost, because you produce what? Should it get rust in the warehouse? No. So that also includes the delivery cost and all other costs which are in this process. So the EBIT is basically your earnings before interest and tax, okay? Which you can find, no problem. I think I've shown you the income statements of some companies many times, so I guess you can see where is it. This you divide by the change in the revenue and higher. So basically it shows that how much profit you are able to extract from revenue. Imagine there's one company. It has 100 euros revenue, and there's another company which has 100 euro revenue, and this remains same, it doesn't change. And for one company, the EBIT is 20, but for the other company, EBIT is 30. Yeah. So you can imagine that the second company is making 30%, is extracting 30% of revenue in the form of profits. Whereas the first company is only able to extract 20% of the revenue as profit. So this is how we are calculating it. But I give you one example here. You see here, on the one side, the left side of the table, you see that there are years. So it's, don't worry, it's a very old data, but it's, don't worry. So I took around 10 years or 11 years, okay? And then you see that the net sales, net sales. If you're not able to get the data of net sales in your case company, don't worry, just take total revenue. Total revenue, total sales, same, doesn't make any difference. And then we make a change, percentage change. Now, please notice the cursor. If you do in Excel, you would be doing it is equal to, bracket starts, 2000 minus 1454, bracket closed, divide by 1454. This would give you 37.55. So it's like the way we calculate the stock return, you know, the same rationale is here. And then you carry on 2759 minus 2000, divide by 2000, but be careful of the brackets, okay? So we have a data, we have another column which shows percentage change in sales or percentage change in revenue. And because this data is for 10 years or 11 years, and we find the average of this. The average is 32.58. So basically, I took these numbers and I count how many are they? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So if you just have the average function and you select this data, that would show you the average change in revenue. Okay, and then we have next column, EBIT. And once again, it is taken on the periodical basis. Basically, both these data you can get from the income statement. You don't have to go to balance sheet or anywhere else. So you can get it from the income statement. And here we have EBIT. By the way, just in case, if you're not able to get EBIT, I know in some companies' cases there could be a problem. If you can find operating profit or EBITDA, is fine. So as long as it's consistent, right? It's fine. So I'm not very insistent about it. In the same way, we calculate the percentage change in EBIT here. So in Excel, it would be is equal to, bracket starts, 127 minus 98, bracket closes, divide by 98, and this would give you 29.59. And when you go to the corner, click, and this goes all the way down. And then the average of these numbers are 34.94. It means the average change in the revenue over time is 32.58, whereas the average change in the operating profit over time is 34.94. And when we put them in this formula, operating leverage, percentage change in EBIT, divide by percentage change in sales, you get 1.07. And if your operating leverage is more than 1, it's great. So it's a sign of success. But how much? So it means that 1.07 means 1.07 in simple words mean that if your total sales are increasing by 1% each year, your profit is increasing by 1.07% each year. So your profit is overpacing, is faster than the change in the. It means what? Basically, it means what? It means that your revenue is increasing, but your profit is increasing faster. What does it mean? It means that your costs are going down. So your sales revenue is rising faster than your costs, okay? And one of the biggest component of cost, which can cause you trouble, is the fixed cost, because taking care of, managing them, loading them is not a child's play. It's a very complicated job, okay? If you try to reduce your fixed cost, it can be very, as I said, the example of, what's that company? Not company, the Gulf of Mexico, which British Petroleum and Gulf of Mexico is a big story, okay? If you check in Google or in YouTube, you'll have tons of videos about it. And that basically was the problem, that the company was required huge amount of infrastructure. Well, it was not so huge, but because of, it was the time, the crisis period in the last decade. So they were trying to postpone it, right? And what happened? Eventually, everything broke down. So this is about operating leverage. That's the first topic which I wanted to discuss. And what you need to do is that you are required to calculate operating leverage based on at least 5 years data. So pick up a company. That company can be one of the company which you have been analyzing in your previous tasks. So, you know, that should take one of those company. Go to the company's annual reports, take the data for 5 years, and there we are, right? One thing I would recommend you that whenever you are calculating the tasks, always share the full URL with me, if your data source, okay? That would give you, because now at some stage you will be doing research, writing thesis, and having the references is very important in your work. Questions, comments? Mm-hmm. No? Okay, now we go to the financial leverage. Financial leverage is the companies borrow. Do you agree? How we see the companies borrow? We go to their balance sheet, we go to their liability side, and there we have two blocks, the current liabilities and the non-current liabilities. Both in the current liabilities and in the non-current liabilities, we can see words such as debt, borrowing, finance debt, interest-bearing liabilities. So these are some of the phrases which would draw your attention that this is the borrowing, this is the debt, both in the current assets and in the non-current assets. So your job is to put them together, and when you have them together, that would show your total debt. So the companies borrow. They borrow more, they borrow less is a different question, but the companies do borrow. In the very rare cases, there'll be no borrowing, but that's very few companies. I remember when some 15, 16 years ago, for example, the companies like Microsoft were having almost zero borrowings. So hardly they would borrow, okay? But nowadays Microsoft has a lot of borrowings. So yeah. You calculate beta, do you? I don't think I need to explain what is beta now. The beta you calculate is called levered beta. Levered because the word leverage is attached to the debt. So more debt, more leverage. So we say that this firm is levered, is getting more leverage. It means that the company is getting more and more debt, basically. The debt reflects on your stock price. And based on the stock price, you calculate what? Beta. Do you get my point? If a company is borrowing more, this action of the company would be reflected on the company's stock price. And when you have the stock price based on that, you calculate the beta. It means that the beta, even though it's calculated based on the equity stock price, but it implicitly includes the impact of leverage on it. Can you build the story? Can you see the connection between the two? If a company is borrowing more, huge, and if this news go to the stock market, many shareholders would be very angry that why the company is borrowing so much. And as a result, there'll be massive sales of shares. Nobody's buying more. As a result, the price will go down. The fluctuation, the change between the price would be huge. And as a result, the market risk beta would go up. It means that when the company is playing with its amount and nature of debt, it has an impact on the stock price, and the impact of the stock price is captured by this word beta. In other words, the beta that you have been calculating so far is called leverage beta. So the word is leverage, or maybe I can type it here. So the beta that you have been, or maybe there's no need. The beta that you have been calculating so far is called leverage beta or levered beta, or even equity beta, because it's based on equity. Okay, it means that all else being equal, the company with more debt would have more equity beta, more levered beta, and the company with less debt would have lesser equity beta or levered beta. But then comes, look, in finance, we do a lot of what if analysis. What if this happens? What if that happens, right? Scenario analysis, we call it scenario analysis. Sometime you may be interested to calculate that, hey, what if the company has no debt at all? What if all these companies have zero debt? How would their beta look like? It's a matter of curiosity. But Sometimes we know that I wear certain type of outfits. Sometimes it just become experimental. Hey, what if I wear this thing? How would I look like? Or what if I had a different hairstyle? Unfortunately, I don't have very long hair now. I cut them last semester. I have a haircut once a year. Yeah. So sometimes you want to experiment. What if the company has no debt? Based on that, when you assume that the company borrows nothing, there's no debt, then you recalculate the beta. That beta is called unlevered beta or asset beta. Asset. Because there's no debt, it's all equity. Equity, debt, assets equal to equity in that case. There's no debt. So when you are having this what if analysis, that hey, just imagine, I know the reality is that there is a debt, but just imagine there's no debt. How would our beta look like? Then you are calculating the unlevered beta. Okay, now and that's a formula here, nothing to worry about. So the unlevered beta is basically equal to the levered beta. I know you all have levered beta. Don't say me that you don't have levered beta by now. You have levered beta. Task 2 is based on levered beta. Task 3 is based on levered beta, by the way. So it means you have some beta. And those betas, by the way, are levered betas or equity beta. All you need to do is to convert those levered beta into unlevered beta. And how you do it? You divide by bracket starts 1 plus 1 minus corporate tax rate. Okay? And this corporate tax rate is not the headline corporate tax rate. This corporate tax rate is the tax which you pay, actually. It's called ETR. It's also called ETR, which means effective tax rate. And how do you get it? Now I think I have to give you the formula how you get it. How you get it? Well, it's very simple. The effective tax rate. Oh no, not this. Okay, whiteboard. Yeah. So the effective tax rate, if I choose text, not text. So this would be effective tax rate is equal to the tax you pay, the actual tax the company pay. This data is available in the income statement. Divide by profit before tax. Sometimes it's called earnings before tax. And sometimes even it's called gross profit. So these all are different expressions. There may be some more words also. So the tax amount you pay, or amount of tax, yeah. So the amount of tax you pay and then you divide by profit before tax. Let's say there's a company and this company has tax, it pays $2 million. And the company has profit before tax is equal to, let's say, 10 million. Then the ETR would be equal to 2 divided by 10 equal to 20%. And let's say this is an American company, but if you Google corporate tax rate in USA, it might be that the headline tax rate in the whole country is 15%. I don't know, but so you need to find that tax rate which the particular company in question is paying, not the Googled tax rate. Okay, So be careful. So it's not the tax rate, it's the effective tax rate, ETR, right? Okay, good. Then I go back to slide. Yeah, come back here. And this is levered beta, which you have. Divide by bracket starts. You be careful of the brackets. You don't put the brackets, it's disastrous. 1 plus 1 minus corporate tax rate. And this corporate tax rate, we just found how to calculate it. It's always equal to the amount of tax you pay, divide by the profit before tax. And then you multiply with debt to equity ratio. Okay, look, the things are so easy. Levered beta, you have it. The levered beta, you have it. How to calculate corporate, don't ask me how to put 1, but how to calculate corporate tax rate, you know, I told you how to do it. And both inputs of effective tax rate come from where? Income statement. And then come debt to equity ratio. Where is debt? Where is equity? In the balance sheet. How to calculate debt? Go to your balance sheet, go to the liability side. The two sections in liability side, the current liabilities and the non-current liabilities. In the current liabilities, you have somewhere the word debt, loan, all the synonyms, debt, loan, borrowings, finance debt, the interest bearing liabilities. You have those phrases, you can get it. If you don't get it, come to me. You have them in the current liabilities, you have them in the non-current liabilities. Make sure you check in both. And if you have in both of them, add them up. Just add them up. Okay? And then divide by the equity. Where do you find it? Again, here we have a divided school of thought. One group of people, they say that the equity should be as it is shown in the balance sheet. You know? Have you seen equity in the balance sheet? You see in the balance sheet, it's called total equity. And normally the formula of total equity is that total assets divided by, total assets minus total liabilities. Okay, so that is the total equity. But some people say that the equity should be the market value of equity. And how do you find the market value of equity? It's called market capitalization, right? You can check in the pages like Yahoo Finance, or you can check in investing.com or in Wall Street Journal. So I have given you many references where you can find the market value of equity, but I give you a choice. I give you a choice that the equity you can choose either the book value of equity, which is in the balance sheet, or you can find the equity from the web page, which equity is basically the market value of equity. And what is the word we use for it? Market capitalization. Market, sometimes they say full word market capitalization, but sometimes they also use the word like something like cap. Just market cap, the market capitalization, okay? It's very easy to find. I can very quickly show you. If I share my screen with you. Okay. If, for instance, I go to this page, Yahoo Finance, Yahoo Finance, yeah. And if I go to, let's say, for instance, Apple, and you're interested in finding the market value of equity, no problem. And you have chosen Apple in Apple Incorporation, yeah. And look at that, market cap, the market value of equity of Apple is $1.999 trillion. So it's almost $2 trillion. Goodness gracious me, I'm almost fainting. Look at the value. Some countries do not have so much of GDP. And this is the market value of the company. But you can have, if you're interested in finding the book value of equity, no problem. Go to the annual report of Microsoft, Apple, or whichever company, and see in the total equity in the balance sheet. Simple. If you want to take book value, fine, no problem. You will not be treated unfavorably, whether you take market cap or the book value of equity. It's a matter of convention. All right, here we go. Come back to my slides. I love them. Okay, and then you divide by this debt to equity ratio. And remember, debt will, see what? The debt is also trading in many companies' case. Like equity trades, debt also trades. But the probability of finding the market value of debt is very low. I normally prefer finding debt purely and only from the balance sheet. Okay? Finding the market value of debt is not easy, but finding the market value of equity is so quick. You know, just go to the page and find it. And here we are. Now, this example I want to give you. Have you heard this company's name, TwoSoft? Have you? Have you heard this name? Who has heard the name of this company? Are you serious that you don't know nothing about this company? I'm shocked that you are the students of finance and you haven't heard about this company. Think about it. Have you heard the name? Oh, this is a fake company. Just cook up. It's just fake. I just got inspired from Microsoft. So I said, hey, Microsoft TwoSoft. So it's TwoSoft company. This company let's say I become more cynical. This company is based in some small, maybe 10 meters times 10 meters small room in somewhere in the outskirts of Uvascular. And some IT guy or some business and IT guy, they make a team and say, hey, let's make a IT solution company. So basically they're doing what these big IT companies are doing, but on a very small scale. You get my point? And then they become ambitious. Hey, what if one day our company become public company? What would be our beta? You know, there's no limit to flight of fantasies. You can fantasize anything. Hey, what if one day we become a public company? Who we will compare ourselves with? Well, we would be comparing ourselves with Microsoft, Oracle, Adobe. And what would be our beta? No worries. Let's calculate. And then these two guys, they go to the web pages of Microsoft, Oracle, and Adobe, and they find that, or they calculate like you guys calculate, that equity beta or the levered beta is this, and this for 3 companies. And their debt and equity is this much. Right? And then they find that the risk-free rate in the US is 4%. Why I'm getting this information? Because I need to use CAPM, Capital Asset Pricing Model. The risk-free rate is 4%, and the risk premium, by the way, be careful, is this is how CAPM look like. Now I wish I could show it. This is how CAPM look like. Required return is equal to risk-free rate plus beta times RM minus RF. Okay, and this RM minus RF, this gap is called risk premium. Make sense? So it means that 8.4% in this question is basically already equal to RM minus RF. Don't do it again, okay? It's already calculated. So RM minus RF are already calculated. The corporate tax rate is 34%, and this 34% tax rate is the effective tax rate of each company. Anyways, How to calculate it? Very simple. You find the average. Yeah, you find the average. This 0.83. Sorry. This first I calculate this one. Sorry, something happened to my. I think that there is this room is two. The 4% is the risk-free rate. 8.4% is this, the risk premium, yeah, and 0.94 is the average of this thing. 0.94 is the average of their levered betas or equity betas. Sorry. Then we put them here, and we find that this comes to be 10.97%. 10.97%. It means that now those two boys, they're chatting and they're discussing that if we were a listed company, or if we become listed company, then we must give, sorry, 11.89, yeah. So if we become the listed company, public company, then the minimum return we must give to our equity share investors is 11.89%. And then their flight of fantasies never end yet. They say, hey, what if we were not only a listed company, but we also are interested to find our unlevered beta, assuming that we don't borrow anything. The entire company is equity financed, zero debt. In that case, they say, hey, no problem. We have 0.73. We have 0.75 beta of Microsoft equity. Let's convert it to unlevered beta. So see what? Can you see this formula here? Does the bell ring? This is exactly the formula I showed you here when you are changing the levered beta to unlevered beta. Yeah? So since I have levered beta of Microsoft 0.75, I know what is D to E ratio, just divide D by E here. I know there is a risk-free rate 4%. I know the risk premium is 8.4%, and I also know that that effective tax rate is 34%. So I have all the inputs. So what I do here, I change the Microsoft levered beta into Microsoft unlevered beta by using the same formula I showed you. So this is the levered beta, which is equity beta, which you calculate by yourself. You have been doing, I know. And this is, you are just making it unlevered beta. And the same formula, the same technique you apply for Oracle, you do for Adobe, and then find the average 0.83. It means that, basically it means that if you become a listed company today, then your levered beta would be the average of this, because these are levered betas or equity beta, that would be 0.94. But if you choose to become an unlevered company with zero debt, then your beta would be 0.83. So it means that there's an 11-point shift, riskiness coming in your beta purely because of being with debt and being without debt. So debt pushes systematic risk up. And then you're interested that, hey, when we assumed to be levered beta, levered company, and then we have this beta, and then we also know that we should give minimum 11.89% to our investors. Now, because we are able to calculate our unlevered beta, how much return we must give to our investors? Well, again, use CAPM. The only thing different is that now you put beta 0.83, not 0.94. 0.94 come from here, the average of these three, 1, 2, 3, 0.94. But that's levered beta. Now this time you're calculating unlevered beta. And when you put it, it comes to be 10.97%. It means that if you are a listed company with no debt, then you would be giving, the bar would be lower now. You don't have to give them 11.89%, but now you give them 10.97%. Debt makes company risky, and because of the risk, the minimum delivery of return which you must give goes up. But when you choose to have less debt or no debt, then your beta will go down, and also the minimum return which you must give to your investors also go down. And here we go. This is called how to transform levered beta into unlevered beta. I repeat, the beta you see in the headlines in the financial pages, or the beta that you calculate in Excel, is levered/equity beta. You have to modify it to unlevered beta by using these numbers. And that is, you must have the corporate tax rate, and I said not the headline tax rate, but the effective tax rate. And then you need to get the data about debt, which come from short-term debt and the current plus non-current debt, and the equity. Equity you can pick from simply from the balance sheet, or you can see from the market cap from the web page. It's your choice, but be consistent. If you do for 3 companies, you can't pick one from the balance sheet and one from the web page. No, be consistent. And then you are able to calculate task 6 and task 7. Task 6 is you're only calculating the levered and unlevered beta of your company. But in task 7, you go a step forward and you also calculate the, oh no, it's the same wording, quite same. Calculate levered and unlevered beta of your company. And here, okay, well, I'll make some minor correction, but because here my point was that, or maybe I merge tasks 6 and 7. Okay, but now you know what it means. That if you know, if you have the equity beta, you can make it to unlevered beta. And when you have the levered beta and unlevered beta, you can calculate the cost of equity. And how do you get cost of equity? Just use capital asset pricing model, CAPM. That's it. There are more models, like we have the arbitrage pricing theorem. We also have this Gordon's growth model, but I think CAPM is most widely accepted, and it's simple to find calculators. It fits very well. And this is not an advanced course of financial management, but so therefore I don't want to go into those other theories. All right, that's it. So it seems that I need to slightly change the wording of this task 7. Or if I don't find anything really interesting to have relevant to have a new task, maybe I would merge 6 and 7 together. But wait for a day or 2. I'll make some changes to it. And here we are. Questions, comments? You guys okay?
That looks easier said than done.
Huh?
That looks easier when you say it.
No, it will be. You just have to sit. First of all, you need to find some time for yourself. Time, sit, be patient, take it easy. And remember these tasks. If task 6, you don't have to do everything new, basically, because you know the betas already. So they are like, is a step-by-step way. All right, so then if you have no questions, then we close our meeting, and good luck to you, and see you soon. Take good care of yourself, and be safe. The corona cases are still around, so be watchful.